BP just reported $3.8 billion in profit. But the real story goes far beyond the numbers. From new energy discoveries to major strategic shifts, something bigger is unfolding. Let's break down what investors need to see. Only on the FinTalk channel.
Welcome to this deep dive. Today, we are opening up a very specific and frankly, pretty dense source document.
Very dense.
Yeah, it's BP's first quarter 2026 financial results. Specifically, we're looking at their Form 6K that they filed with the SEC in April 2026.
Right.
Now, I know that for most people, sitting down to read a 40-plus page corporate accounting filing sounds like a total chore.
I mean, it's definitely not light reading for a Sunday afternoon.
Yeah, definitely not. But the mission for our deep dive today is to really look past those dry tables and the accounting jargon. We want to use this specific ledger as a lens to show you how the world actually works.
Exactly. Because when you break down the financial statements of a multinational energy conglomerate, you aren't just looking at math, right? You're looking at a real-time map of global trade routes.
Right.
And you're seeing the immediate financial fallout of geopolitical conflicts and really a masterclass in shifting corporate strategy.
Yeah, and I think that is the most productive way to approach these filings for anyone listening. The goal isn't to just recite a list of balance sheet metrics to you.
No one wants that.
Right. We want to unpack the mechanisms behind those numbers. We want to explain how these massive corporate decisions are actually executed on a global scale.
Because understanding those mechanisms gives you such a clearer picture of the broader energy landscape. It really does.
So let's start with the loudest number in the room, because if you look at the very first page of this report, there is just a staggering financial swing.
A huge swing, yeah.
I mean, in the fourth quarter of 2025, BP reported a $3.4 billion loss. And then just one quarter later, in this Q1 2026 report, they posted a $3.8 billion profit.
Right.
On the surface, I mean, a $7 billion swing into the green looks like an absolute triumph, doesn't it?
It looks incredible on paper.
Right.
But the document immediately cautions the reader to not focus on that $3.8 billion headline.
Okay, so what should we be looking at?
Well, it directs our attention to a different metric. They call it underlying replacement cost profit, or RC profit for short. And that number sits at a much lower $3.2 billion.
Interesting.
Yeah, and it justifies this difference by pointing out what they call a $4.2 billion inventory holding gain.
Okay, I need some help visualizing this. Because how on earth can an inventory holding gain just, artificially inflate a company's profit by over $4 billion in 3 months?
So to understand that discrepancy, we have to look at the mechanics of corporate accounting, specifically a method called first in, first out, or FIFO.
FIFO.
Exactly. So BP, just by the sheer nature of its global operations, holds millions of barrels of oil in storage tanks and on ships at any given time, right?
Makes sense.
And under FIFO accounting rules, the cost of that inventory is recorded on the income statement based on its historical purchase price or its production price.
Okay.
But, we are talking about a highly volatile energy market here.
Which means the global price of that oil is changing every single day while it's just sitting there in the tank.
Yes, exactly. So let's say BP produced or bought a barrel of oil several months ago when the market price was lower. By the time they closed the books for the first quarter of 2026, the global market price for oil has spiked.
Oh, I see.
Right? So suddenly the oil sitting in their tanks is worth significantly more on paper than what they originally paid for it. That difference, that is the $4.2 billion inventory holding gain.
Wow. So it is strictly a paper valuation.
Entirely. BP didn't run their refineries more efficiently or invent some new extraction technology to earn that money. The market simply drifted upward around them.
It sounds a bit like holding a stock portfolio. Like if my index funds go up by 10% in a week, my net worth on paper looks fantastic.
Right. You feel a lot richer.
Exactly. I feel richer. But my actual salary from my day job hasn't changed at all. I can't use those unrealized stock gains to pay my grocery bill unless I actually sell the assets.
That analogy holds up perfectly. And this is exactly why the concept of underlying replacement cost profit is so vital for your corporate literacy.
Because it strips out the noise.
Yes. If you are trying to evaluate the operational health of this business, that $4.2 billion paper gain is entirely distorting. It masks their day-to-day operational competence.
Ah, okay.
By stripping out the changing value of the oil they merely hold in storage, BP arrives at that $3.2 billion RC profit. That number reveals what the actual day-to-day business earned by moving, refining, and selling energy products to real customers.
Okay, that makes complete sense. We ignore the paper windfall and focus on the 3.2 billion in actual operational profit.
Right.
But, when we dig into the outline of where that 3.2 billion actually came from, the results run completely counter to what you might expect.
Well, absolutely.
I mean, when someone says BP, the immediate image that comes to mind is an offshore oil rig or a sprawling pipeline.
You think of an industrial extraction company pulling hydrocarbons out of the earth.
Right, exactly. The upstream business. Extraction has historically been the primary identity of these majors.
Yes, it has.
Yet, according to the breakdown in the document here, their extraction businesses, the oil production and operations, and gas and low-carbon energy segments, they faced serious headwinds this quarter.
They really struggled.
The true hero of the Q1 ledger was actually their customers and products segment. That segment delivered 2.5 billion of that total 3.2 billion underlying profit.
Right.
And the document credits this to higher refining margins and an exceptional oil trading contribution. So, wait, how is it that the people trading the oil and refining the oil are vastly outperforming the people actually pulling it out of the ground?
It's fascinating, isn't it?
Yeah.
It all comes down to market conditions and the mechanics of the energy value chain.
Oh, cool.
Let's look at the upstream extraction struggles first.
Okay.
The report notes they were hit by the adverse impact of price lags.
Price lags.
Right. To understand a price lag, you have to look at how global oil and gas contracts are actually structured. Many of these contracts don't price a barrel of oil at the exact spot price on the day it is physically delivered.
Okay. How do they do it then?
Instead, they use formula pricing. So it's often tied to a trailing average of the previous month's prices, or they might even involve price caps.
I see. So if global oil prices suddenly spike in March, BP's upstream division might still be locked into selling their March deliveries at the lower average price from February.
That is the exact mechanism. They're contractually stuck selling a cheap barrel in an expensive market.
Ouch.
Yeah, so they couldn't fully capture the upside of the volatile market at the point of extraction. But downstream, in the customers and products segment, volatility is an opportunity rather than a hindrance.
Right, because they are trading.
Exactly. The document highlights their midstream performance, specifically stronger supply optimization and oil trading.
Okay, supply optimization sounds like a corporate euphemism. What does that actually mean in practice? Like, how does an energy major execute an exceptional trading quarter?
It's a combination of financial derivatives and physical logistics. You have to remember, BP isn't just day trading oil futures on a computer screen.
Right, they have physical assets.
Huge physical assets. They control a massive physical network of ships, storage terminals, and refineries. So supply optimization involves geographic and temporal arbitrage.
Give me an example of that.
Sure. Let's say a local geopolitical event causes a sudden shortage of diesel in Europe, while prices remain totally stable in the United States.
Okay.
BP's traders can identify that dislocation and literally reroute a physical tanker of product mid-ocean. They'll turn it away from a low-margin port and send it to Europe to capture the premium.
Wow. So they are leveraging their sheer scale. Because they own the physical infrastructure, they can move the actual product to wherever the spreadsheet says it's most valuable that day.
Exactly. And they can hedge those physical movements with financial contracts to lock in the margins.
That is incredible.
In a quarter defined by high volatility and supply chain friction, the ability to buy, route, and trade energy products proved far more lucrative for them than simply pulling the raw commodity out of the ground.
Which is wild to think about.
It is. And they also benefited from a recovery in refining. The document notes their Whiting refinery returned to normal operations after capacity reductions in the previous quarter.
Right.
That brought their overall refining availability up to over 96%.
It really reframes the entire company. You start to see them less as just drillers and more as local logistics experts.
Exactly.
There is also a detail in that customer segment I want to touch on quickly before we move forward. The report notes that Castrol, their lubricants brand.
Right, the motor oil.
Yeah, they began their official Formula One partnership with Audi this quarter. The document positions it as a move to build brand equity and showcase technology for the new 2026 F1 regulations.
It's a helpful reminder that at the very end of this complex, multi-billion-dollar supply chain, there are actual consumer-facing products.
Yeah, totally. Which brings us to the cause of all this volatility. We know that trading and refining carried the quarter because the market was fractured and volatile, right? Well, the source document is very transparent about why that is. It specifically points to the geopolitical landscape. The report states they are closely monitoring the conflict in the Middle East.
Yes.
And they explicitly link this conflict to high market volatility, those price lags we discussed earlier, and margin dislocations driven by soaring freight costs.
This section of the 6K is really where corporate accounting intersects directly with global affairs.
Definitely.
The friction in the Middle East disrupts normal shipping routes. That drives up the cost of freight. It alters the differentials between different grades of crude oil, and it basically forces companies to constantly reassess their baseline assumptions.
And BP actually quantified that reassessment in this filing. Because of this friction, they fundamentally altered their core financial assumptions for the rest of 2026.
Great.
They revised their Brent oil price assumption upward to $82.80 per barrel. And they noted this assumes the Middle East supply disruptions resolved by the end of the year.
Which is a big assumption.
It is. But then, in the exact same section, they revised their Henry Hub gas price assumption downward to just $3 per million British thermal units. And they cited an expected oversupply in the U.S. domestic market.
That divergence is crucial for understanding how multinational capital works.
Yeah.
You essentially have two entirely different economic realities playing out simultaneously.
Yeah, it's wild.
Brent crude is a global benchmark.
Right.
Because oil is highly fungible and easily transported across oceans, a conflict in the Middle East restricts global supply routes, which pushes the price of every single barrel upward.
Right.
BP has to adjust their long-term impairment testing models to reflect this higher $82.80 reality, which changes how they value their international assets.
But the U.S. natural gas market operates under a completely different set of physical rules.
It really does. The Henry Hub benchmark represents a somewhat isolated market. The United States produces a tremendous amount of natural gas, but exporting it requires liquefying it into LNG.
Right, liquefied natural gas.
Yes. And there is a hard limit on the country's LNG export capacity. So a large portion of that gas is physically trapped within the North American market.
So it can't just be shipped overseas to where prices are higher.
Exactly. If production outpaces domestic consumption, you get a localized glut.
Which drives the price down to $3, even while global oil prices are rising. This raises a critical question for you as the listener.
Yeah.
The document notes BP plans to spend between $13 and $13.5 billion in capital expenditures this year. How do you allocate $13 billion effectively when your global oil assets are gaining value due to war, but your U.S. gas assets are losing value due to domestic overproduction?
It requires an incredibly disciplined, localized approach to capital. You can't just apply a blanket growth strategy across the entire portfolio anymore.
You really can't.
No, you have to aggressively direct capital toward the high-margin environments, perhaps doubling down on offshore oil or trading infrastructure, while actively minimizing expenditures in the oversupplied U.S. gas basins.
So it's a constant recalibration.
Exactly. It is a constant recalibration of reality based on shifting regional data.
And it seems that need for discipline is driving a major strategic shift in their balance sheet. Because they are operating in this unpredictable global environment, the latter half of this report reads like a blueprint for aggressive corporate restructuring.
Very aggressive, yes.
They are divesting legacy assets and changing their capital structure to build resilience.
Resilience is definitely the operative word here.
Yeah.
What specific divestments stood out to you in the filing?
Well, they're targeting a very specific number. They want $9 to $10 billion in divestments for 2026.
That's a huge target.
It is. And the two major moves are, first, the sale of a 65% stake in Castrol, that same brand we just mentioned involved in the F1 partnership. They are selling that stake to Stonepeak for roughly $6 billion. They are keeping a 35% interest. But the document notes Stonepeak receives preferred distributions, so BP isn't expecting any near-term income from it.
Right.
And the second major move is selling their Gelsenkirchen refinery and its related businesses in Germany.
Selling a major chunk of an iconic consumer brand and offloading physical European refining infrastructure.
Yeah.
Those are substantial moves designed to radically simplify their portfolio.
And they are using the capital from these sales for some very specific financial engineering. They are reducing their perpetual hybrid bond capital from $13.3 billion down to $9 billion.
Right.
Now, I understand paying down regular debt, but what exactly is a perpetual hybrid bond and why target it specifically?
So a perpetual hybrid bond is a specialized financial instrument. It sits somewhere between debt and equity.
Okay.
It doesn't have a maturity date, hence the term perpetual. And rating agencies often treat a portion of it as equity. This helps the company protect its credit rating without having to issue actual new shares, which would dilute existing shareholders.
It sounds like a pretty useful tool for a capital-intensive business. Why are they in such a rush to pay it down?
Because that flexibility comes at a cost. The interest payments, or coupons, on hybrid bonds are typically much higher than standard senior debt.
Oh, I see.
By taking the cash from the Castrol and German refinery sales and permanently retiring over $4 billion of this hybrid capital without replacing it, BP is shrinking its structural baseline.
So they just don't have to pay those massive interest bills anymore.
Exactly. They no longer have to pay those high ongoing interest costs.
Oh.
It is a calculated move to become leaner and more cash flow efficient.
You know, it sounds like they are essentially cleaning out the garage.
That's a good way to put it.
Yeah, they are selling off the physical clutter, a refinery here, a majority stake in a brand there, to pay off their most expensive high-interest credit cards, all while continuing to place new bets on the future.
Right.
Because the report highlights they acquired a 60% interest in 3 offshore exploration blocks in Namibia, and they finalized a major gas discovery, the Denise W1 well in Egypt.
That is the ultimate balancing act of an energy major right now, shrinking the legacy structure to fund future exploration.
And speaking of legacy structure, there is a literal ghost in this document that they are still paying for.
The Gulf of Mexico.
Yes, the Gulf of Mexico oil spill. It has been 16 years, yet the 6K explicitly states they expect to pay $1.6 billion pre-tax for Gulf spill settlements in 2026 alone.
It's unbelievable.
They already disbursed $400 million of that just in the first quarter. The sheer financial stamina required to absorb a $1 billion annual penalty for a decade and a half is staggering.
It really underscores why this aggressive balance sheet strengthening is so critical. I mean, they are managing historical crisis payments, modern geopolitical volatility, and the massive capital requirements of future exploration all at the exact same time.
It's a lot of plates to spin.
It is. Their stated primary target is to reduce their net debt. Currently, the document lists their net debt at $25.3 billion.
Okay.
They want to drive that down to a range of $14 to $18 billion by the end of 2027.
That is a long way to go in a very short amount of time.
It is, but the strategy is actually bearing fruit. The report notes that Standard & Poor's recently revised their credit outlook on BP to positive.
Oh, nice.
Yeah, and securing that high-grade credit rating lowers their overall cost of borrowing. But perhaps more importantly, this entire restructuring, the divestments, the debt reduction, the supply optimization, it all serves one ultimate goal.
Protecting shareholder returns?
Exactly, protecting the dividend. They are targeting at least a 4% increase in their dividend per ordinary share every single year.
Wow.
For this quarter, they announced a payout of 8.320 cents per share. In an industry defined by unpredictable commodity swings, you literally cannot guarantee a steadily growing dividend unless your financial foundation is meticulously organized.
And highly resilient to external shocks. It is just fascinating to see the interconnectedness of it all. I mean, we started by looking at a headline accounting swing. Then we dug into the mechanics of why physical oil traders outperformed the actual extraction teams.
Right.
We mapped out the localized impacts of global conflicts and finished with a strategic restructuring of billion-dollar debts. This single document really does serve as a decoder for the broader economy.
The depth of information in these SEC filings is truly remarkable if you take the time to read past the summary paragraphs.
It really is.
And before we conclude, I want to leave you, the listener, with a final thought to consider. And this is drawing entirely from the trends we've analyzed today.
Okay, let's hear it.
We have watched BP actively shed physical industrial assets, right? Offloading a German refinery and a 65% stake in their Castrol lubricants business.
Right.
At the very same time, we saw their quarterly underlying profits rescued not by the physical extraction of hydrocarbons, but by their own admission, an exceptional oil trading contribution and complex supply chain optimization.
The logistics and trading desks providing the real value.
Precisely. So the provocative question becomes this. If a legacy oil major is increasingly deriving its highest margins, not from the industrial capital-intensive work of pulling resources out of the ground, but from paper trading, spatial arbitrage, and optimizing global supply routes,
Yeah.
at what point does an energy major stop being an industrial extraction company and start functioning primarily as a massive infrastructure-backed commodity hedge fund?
Man, that is a phenomenal question. And it completely shifts how you evaluate their future moves in the market. Are they drilling for oil or are they just trading the volatility of oil?
Exactly.
Well, thank you for walking through the mechanics of this with us. And to you listening, I encourage you to take this analytical approach the next time you encounter a corporate financial report.
Absolutely.
Don't just scan for the headline profit or loss. Look for the underlying operating numbers, question the mechanisms behind the segment profits, and find the real story hiding in the margins. We will see you next time.